You mentioned Silvercrest, and that's a big name. It's a really high quality asset that I think it's about to come onto production with and they're ramping up to 12 million ounces a year. Is that one of and you're right, the stock is way off. It's gotten sold out, thrown out, the baby thrown out with the bathwater. Um, and there's good names like Silvercrest that have come down a lot. Is that the type of name you would tell people to take a close look at? A
Most
high
people,
quality producer like that?
most people, yes. Look for something where maybe the story is behind the company, or something that sold off just because it stopped going up. There are a bunch of people who own Silvercrest that have no idea why they owned it. And the consequence of that is that many of them sold it, not having the courage of their convictions. If you've spent as much time on Silvercrest as I have, and if you've had the benefit of being part of Sprott, which was there from before the time it was public, you can have a reasonably high degree of confidence. If you see a deposit that's absolutely positively going to grow, which it is, and you see a deposit that's in the quiet period leading up to production, which it is, and you see it in a sector where the commodity's out of favor and you think it's going to go up, and you think as a consequence of that, that after the commodity goes up, the sector's going to re-rate. If in your own mind, you are willing not to have too much psychological verification, I think that it's not unreasonable to look at a 5-year 5-bagger. And that's sort of fun.
Yeah, their cost of production is ridiculously low, way lower than the industry average. And that's really what you want to look for a silver play, correct?
Well, it certainly gives you coverage to the downside. If it takes longer for silver to recover, those guys make a lot of money at $18. I happen to believe that on a nominal dollar basis, that in the next 5 years, silver trades north of 50. And so I always run myself a $20 case, and then I run a $25 case, and then I run a $50 case. And I do valuations on a matrix of pricing assumptions. Ironically, the companies that don't make any money at all at $20 are the guys that generate the largest pro forma increases at $50, which is to say the inefficient producers offer more leverage.
Mm-hmm.
But I'm inclined to look at both my upside and my downside. And if I have circumstances where at $20 I don't have a downside, I can afford to be a little more generous with myself in terms of what upside I'm willing to take. And I think Silvercrest is a wonderful example. I didn't mean it as an example to be a stock recommendation. It's because I don't know everybody in your audience. I can't give them recommendations. But as a learning exercise, the value proposition around Silvercrest is, I think, instrumental. Another name, just for educational purposes, would be Pan American. Hammered in price. Hammered, I think, because of the real expectation of increasing political risk in Mexico and Peru. Hammered partly because 55% of their revenues are gold now, not silver. Interestingly, all kinds of operating leverage in the company. And importantly, 2 deposits in the company which don't figure into the market capitalization because they're not producing. One in Guatemala, Escobal, 500 million ounce deposit, high grade deposit. The other, the name escapes me, Navidad in Argentina, 500 million ounces. If they receive the go-ahead on either of those deposits, they could more than double Pan American's production. To have that sort of leverage baked into the company, but not baked into the market cap, is an unusual opportunity. And it's the kind of opportunity you only see in markets like this.
Yeah, Rick, former Fed Chair Bernanke this week came out and said the Fed made a huge mistake, and they're way too late to respond to inflation. Are you surprised he made those comments?
Their job is to lie. They the political class, including the Fed, knew that the voters didn't want to take the bitter pill. Everybody liked the party, and nobody wanted the vodka to come out of the punch bowl. It's easy to say we screwed up. They knew 8 years ago they were screwing up. They knew 5 years ago they were screwing up. They knew 2 years they were screwing up, and now he gets to do a mea culpa. Mm-hmm. So am I surprised? No. And am I surprised, by the way, that the voters wouldn't allow the politicians, and the politicians had no interest anyway, in doing the right thing? Mm-hmm. Think about what doing the right thing would be for those of your listeners who were around in 81, 82, 83. Volcker did the right thing, and it was extremely unpleasant for people who were marginally employed or involved in marginal businesses. And doing the right thing here, allowing a free market at interest rates, would mean, as an example, that the US 10-year Treasury, if the CPI stated rate of inflation is at 6.5, probably a conservative estimate, that would mean that the US 10-year Treasury would be at 7. That would mean that federal, state, and local governmental budgets, just the interest payable, would triple. Traditionally, the 30-year fixed mortgage rate trades in front of the 10-year, which is to say that the 30-year fixed mortgage rate would go from sort of 4 to some number that had an 8 handle on it. That would be a bit of a challenge for people trying to afford houses, and then after that for people trying to sell houses. Traditionally, too, revolving consumer credit, which is to say credit card credit, traditionally has traded at 1,000 or 1,100 basis point premium to the Treasury, which means that on people's credit card debt, if the Treasury was trading to yield a 7, revolving consumer debt would increase from some number like 12 to some number like 18. And I think that would be very difficult for consumers. So while I certainly believe that we should have a free market at interest rates, that the Fed should get out of the way, the consequences for 2 or 3 years for American consumers and American voters would be interesting, to say the least.
Well, what we're facing, all the pressure right now on the Fed is to fight inflation, of all the political pressure. So they got to tighten. And at some point in this process, the economy is probably going to roll over. Housing prices will start trending down. Maybe unemployment will start ticking up. Maybe the market tanks another 30%, or, some catastrophic day where everything's down 10%. Something like that's likely going to happen at some point in this tightening process.